Profit reconciliation is an important application of standard costing and variance analysis, providing a systematic explanation of the difference between the profit originally budgeted and the profit actually achieved during an accounting period. Rather than simply reporting the final profit figure, reconciliation identifies the individual sales and cost variances responsible for the overall difference in performance. This enables management to evaluate operational efficiency, identify areas requiring corrective action, and assess the effectiveness of planning and budgetary control systems. Under both standard absorption costing and standard marginal costing, reconciliation statements provide a logical bridge between planned and actual financial performance, although the variances included differ because of the alternative treatment of fixed production overheads. Purpose of profit reconciliation. The principal objective of profit reconciliation is to explain why actual profit differs from budgeted profit by analyzing individual variances arising from sales, production, and cost control activities. Reconciliation transforms numerous detailed variances into an integrated summary that highlights the major factors influencing organizational profitability. Profit reconciliation supports several important management functions: evaluation of managerial performance, assessment of operational efficiency, identification of significant cost control problems, investigation of sales performance, improvement of future budgeting accuracy, strategic decision-making, and corrective action. By linking variance analysis with financial performance, reconciliation statements provide senior management with a concise overview of organizational performance during the reporting period. Reconciliation under standard absorption costing. Under standard absorption costing, product costs include direct materials, direct labor, variable production overheads, and fixed production overheads absorbed into inventory. Consequently, both sales performance and production volume influence reported profit because fixed manufacturing overheads may be carried forward in inventory when production exceeds sales. The reconciliation normally begins with budgeted profit, after which favorable variances are added and adverse variances deducted to obtain actual profit. The general structure is: add favorable sales price, variance favorable sales volume, variance favorable material price, variance favorable material usage, variance favorable labor rate, variance favorable labor efficiency, variance favorable variable overhead, variances favorable fixed overhead expenditure, variance favorable fixed overhead volume variance. Less corresponding adverse variances. Under absorption costing, fixed overhead volume variance forms part of profit reconciliation because fixed manufacturing overheads are absorbed into production and inventory valuation depends upon production volume. If actual production exceeds budget, more fixed overhead is absorbed, producing a favorable volume variance that increases profit. The fixed overhead volume variance itself may be subdivided into capacity variance, efficiency variance, providing further insight into factory utilization and operational productivity. Reconciliation under standard marginal costing. Under standard marginal costing, inventories contain only variable production costs, while all fixed manufacturing overheads are charged directly against the accounting period. Consequently, profit depends upon sales volume rather than production volume, and fixed overhead volume variances do not arise. The reconciliation therefore begins with budgeted contribution or budgeted profit, depending upon presentation format. The general structure is: add favorable sales price, variance favorable sales volume contribution, variance favorable material, variances favorable labor, variances favorable variable overhead variances. Less corresponding adverse variances. Alternatively, where budgeted profit is used as the starting point, because fixed manufacturing overheads are treated entirely as period costs, fixed overhead volume variances are excluded from marginal costing reconciliation. Only fixed overhead expenditure variance may appear if actual fixed expenditure differs from budgeted expenditure. Comparison of absorption and marginal costing reconciliation. Although both reconciliation methods explain the movement from budgeted to actual profit, they differ in the treatment of fixed manufacturing overheads. Under absorption costing, profit is influenced by sales performance, cost variances, production volume, Inventory changes, fixed overhead absorption. Consequently, fixed overhead volume variance appears within the reconciliation statement. Under marginal costing, profit depends primarily upon contribution generated, variable cost control, sales volume, actual fixed costs incurred. Production volume itself does not directly influence reported profit because fixed overheads are charged immediately rather than absorbed into inventory. The two approaches therefore produce identical total profits only when opening and closing inventory levels remain unchanged. Interpretation of profit reconciliation. Profit reconciliation provides management with valuable information regarding the sources of financial performance. A large favorable sales volume variance may indicate successful marketing strategies or stronger market demand, while favorable material usage and labor efficiency variances suggest improved operational productivity and resource utilization. Conversely, adverse material price variances may reflect inflationary pressures or supplier issues, while adverse labor efficiency variances may indicate inadequate training, poor supervision, machine breakdowns, or production scheduling problems. Under absorption costing, favorable fixed overhead volume variances may arise simply because production exceeded budget rather than because sales increased. Management should therefore exercise caution when interpreting absorption costing profits, as inventory accumulation may temporarily increase reported profit without improving cash generation or customer demand. Marginal costing reconciliation often provides clearer information for internal decision-making because profit depends solely on sales performance and cost control rather than inventory movements. Managerial significance. Profit reconciliation is far more than an accounting exercise. It is a powerful management control tool that integrates budgeting, standard costing, variance analysis, and performance evaluation into a comprehensive financial review. By systematically explaining the differences between planned and actual performance, reconciliation statements enable managers to identify operational strengths and weaknesses, improve future forecasting accuracy, strengthen cost control procedures, and make informed strategic decisions. Consequently, reconciliation of budgeted and actual profit under both standard absorption costing and standard marginal costing represents a fundamental component of modern management accounting, supporting organizational planning, accountability, operational efficiency, and continuous performance improvement.